Hello everyone, a very good evening to all of you who have joined the Stock Durbar. Uh, can you see my screen and am I audible to you guys clearly? If there is any disturbance, you can please mention it on the chat box.
You're audible and the screen is perfectly visible. You can go ahead.
Okay, and yeah, thanks for the replace. Uh, I request all the participants to please unmute yourself and shut down your videos so that it will be a smooth session for everyone who have joined the session. We'll start the session by discussing Nifty index and major indices which impact Nifty's movement. Then we'll move on to stock queries. I think most of the participants have joined. I think we can go ahead with the session now. As you can see, this is the Nifty's daily chart, MarketSmith India's chart. On Monday, Nifty gapped down and it closed 3.1% lower, and it touched almost its 200 EMA for the first time in last 1 year. The major news which impacted markets were one is inflation data coming at higher rates. US inflation came in at 7.7%, that is 40%, 40-year high. Then geopolitical tensions between Russia and Ukraine. These were the two major news which impacted global markets as well as Indian markets. However, on Tuesday, we had a very good rebound from 200 DMA and Nifty closed 3% higher. There were a few reports that Russia is leaving Ukraine territory. So that was very good news for the markets. Today, as you can see, there was very huge volatility in the market because there was high uncertainty regarding geopolitical tensions, as well as UK inflation came in at 5.5%. That is also 30-year high. US inflation at 40-year high and US inflation at 30-year high. These were very negative news for the markets. When inflation is higher, central bank tends to increase interest rates in order to bring down the inflation. When interest rates go higher, then loan activity in the economy comes down. To give an example, when let's think it like a household person who has a loan of 10 lakhs. When the interest rate is lower, it is good for the household to take a higher amount of loan. But whenever interest rate is higher, he will not tend to take more loan because the burden on his income will increase. So that is the reason when interest rates goes higher, the growth in the market tends to be lower. I'm seeing few messages regarding audio. Vakar, am I audible?
Is Rashika audible?
Yes, Manish, I think I'm audible. I think can you check your settings as well? Okay, yeah. So when US inflation is at 7.7% and UK inflation at 5.5%, normally their growth rate is around 1 to 2% because they are major economies, and then inflation rates historically has been around 1 to 2%. This has been never seen in their cycle. So US Fed has to increase interest rates. That is a major reason the fallback is happening in the markets. The same thing is happening in the US market, UK market is as well. So this is a repercussion of global markets we are seeing in the Indian markets. One is inflation, another is the geopolitical tensions. And let's discuss about the major indices which impact Nifty's movement. And Nifty Bank Financial Services has a major chunk of weightage in the Nifty 50. Around 36% is Nifty Financial Services. So let's discuss about Nifty Bank, which is a highly traded index in India, which has weekly options as well. As you can see here, Nifty Bank as well was down 4% on Monday, following the same news. And on Tuesday, it was up around 3% because of Russia going back from Ukraine. However, Nifty Bank has never tested its 50 DMA, 100, 200 DMA during the course, which is a good sign for the banks. There was some news as well regarding banks during the week. A major company defaulting on loans. SBI has a very good exposure to that, and ICICI as well. That was also a very big reason for the huge sell-off on Monday. However, there were reports that that news was already sold into again. So again, the market participants have taken it as a positively that major banks have already reported their NPS regarding that company. And I'll take to the next major session, major index, that is Nifty IT, which has around 18% weightage in the Nifty. Nifty IT and FMCG are mostly called as a defensive indices compared to banks and realty metal indices. Because of their nature, FMCG companies will always have good demand among people, but bank may not have good demand. You can see on Monday, the decline was just 1.5% on FMCG, whereas Nifty declined 3%. However, on Tuesday, it was rebounded sharply 3% because of the positive news. Again, Nifty IT also didn't reach its 200 DMA, which was a good sign. However, during the week, we have downgraded Nifty IT to correction and Nifty Bank to under pressure. And regarding Nifty, we have not discussed it. During on Monday, we have changed to correction because of a huge down move and Nifty breaching its key moving averages. Currently, we are in downtrend, hence we have exited most of all of our portfolio stocks and we are staying sidelines. If we see another session of positive movement, then we will change to under pressure. By the time Nifty should retake its 50 DMA as well. One more index which impacts market movement is Nifty FMCG, which has more than 10% weightage. You can see on Monday it has declined 2.8% and it breached. It is trading below its all key moving averages, that is 50, 200, and 100 DMS, which is not a good sign for growth investors who are looking to invest into FMCG companies. Yeah, this is the introduction I would like to point out, and we can have a few stock queries and we'll discuss about the stock queries.
Yeah, thanks, Rajsekhar. This is Mayuresh here. Guys, can you hear me?
Yes, Mayuresh, I can hear you.
Yeah, so
Mayuresh, we can hear you.
yeah, so other guys, you can just put your hand up or give me a thumbs up so that the wider audience also can hear me as well across. Super, super. Thanks a ton, guys. Thanks a ton. Yeah, so as Rajsekhar pointed out, right, we downgraded the markets this Monday, but I think the evident signs were very, very conspicuous the coming Monday as well. I think so a week before that, you did see a sharp drawdown into the markets as well. And if you guys would have gone through our report where we have mentioned how distribution is happening across sectors. So I think as O'Neill, what we try to follow, what we try to interpret is obviously market data. Secondly, I think in terms and in lieu of what market data has been thrown up, in terms of how the broader indices are performing, a lot of stocks moving below the 50 and 200-day moving averages across sectors, which is not a very healthy sign, if I may put it. And even the RS strength, which is a very key indicator, above 50, very few stocks in terms of the larger elements of 500 odd stocks that we have analyzed and interpreted are still below 50. So I think that gives you a view in terms of all the cocktail of events that we talk about, right? And it's been spoken on regularly across channels. Today, I think, yesterday, I think there was some reprieve in terms of de-escalation happening on the Russian-Ukraine crisis. NATO puts out some statement an hour before market closes, and the market comes off significantly from tops. That is not the only reason. I think what you're looking at in terms of tonight's meetings on what FOMC will put forth is something that we need to also be very, very watchful for. The global markets obviously are very, very watchful on those counts. And for the sake of repeating myself, I think inflationary trends across the globe seem to be very evident at this point of time. Now, there are two elements happening out of inflation as well, as I see it. Whether this inflation will remain sticky over the next few months, or this high levels of inflation because of elevated crude prices, because of supply chain issues, and supply constraints not being able to meet demand, and therefore the cost push inflation that you've seen in major economies across the globe, does that start plateauing? And as supply chain constraints come back online, in terms of no longer logistic bottlenecks happening both in terms of factories as well as congestion at ports when it comes to logistics on sea routes as well, you might see supply related issues slowly and steadily getting off, and therefore the input cost inflation that most companies are facing, and what con calls we attend across the globe, and even in the Indian context specifically, I think all that elements will slowly and steadily start tapering off. But I think it's a contingent event on certain things happening, as I said, and whether that happens or not is largely going to depend how markets will behave over the next few quarters. Secondly, with crude at the level that it is, what the second round effects of inflation if crude remains at elevated prices, obviously I think the current account deficit takes a hit if crude prices keep on moving higher. These geopolitical tensions, along with supply demand issues that get artificially created, right? Because with geopolitical issues, supply probably starts getting choked off, and therefore, as demand remains constant, the expectation of crude prices moving higher sentimentally and on the bourses as well become very, very evident. So, if crude prices remain at elevated levels, obviously, I think the pass through, which has still not happened, right, in the Indian context, because of state elections or otherwise, in whatever context one might need to interpret that, largely will get passed through as the polling dates are largely over across states. So that might lead to some element of elevated inflation, as the RBI governor and as the RBI statement also mentioned for this quarter in particular. So there are a lot of moving parts happening around this side, but whether it is structural, my own sense is that if everything plays out in a reasonable fashion, the next 2 quarters, inflationary trend should start coming off. But the markets will obviously react beforehand. I think that's always been a factoring element of how markets perceive things over the next 4 to 6 quarters. And therefore, I think whatever reactions we will see will happen upfront for the markets. And therefore, I think the entire technical jargon, whether markets are gestating all these elements as play, a Fed rate hike of 50 bips in March, commentary being hawkish, which means that apart from that 50 bips hike, every other meeting probably has an hike as well, which means the tightening cycle puts some end in terms of how free liquidity was moving across equity markets. Global GDP forecasts as a nuance has got slashed down, right? And again, for the sake of repeating myself, what the finance minister said in the budget, what the RBI governor has predicted in the coming year at 7.8%, with inflation at 4.5. Let's see how that moves. But GDP specifically at 7.8 is a signal which we should interpret that global GDP or global growth generally, I think, will not have the same effect because of a lot of liquidity moving around the globe seen during COVID times. And God forbid if we have another wave or another variant coming through. If it does not, I think still the stickiness because of lesser liquidity to the system, raising of rates, slower purchasing power, some element of discretionary spending and demand getting cut down to control those inflation related issues. All those things might relate and get reflected in terms of lower forecasts. Now, how does that play out in terms of corporate earnings? obviously markets also follow corporate earnings to a large extent. And largely, I think the forward valuations, though we are not a very keen supporter in terms of valuation stack up, but yes, earnings do matter to us. And therefore, if the earnings trajectory remains a little bit on the lower side, on the lower band that a lot of people expect or are envisaging that corporate India might grow, you might then assume that the valuations that what India is trading at compared to the rest of the globe will probably play its part. And therefore, what happens largely in terms of markets being stuck in a broad range, consolidating with a time-wise correction, and obviously with a lot of elements playing through, right? What the Fed states tonight, how the Fed rate hikes rate on the actual date itself, and everything is happening in that periodicity of March 8, 10 to March 14, 15. You've got state election results coming on March 10th, the Fed meet which happens on March 14th and 15th, the inflationary trends, and RBI meeting on April, whether they have a change in stance on what accommodative stance they provided in the policy gone by. So I think there are a lot of moving parts, and therefore I think to navigate in the next few weeks, looking at these events is going to be very, very difficult. And that's what the markets are precisely doing, right? Extremely volatile trades for the markets per se at this point of time. The second element obviously is that any of these events playing out not to the liking of the markets, you're going to see a knee-jerk reaction. Therefore, being ready in terms of all these elements at play, and therefore playing it out gradually over the next few weeks is going to be extremely important. As far as the O'Neill methodology is concerned, and what happens in terms of the move ahead, I think as you are all major participants in terms of the O'Neill methodology and following that as well, we downgraded the market on Monday. The next 2 to 3 days is going to be extremely crucial, right? So if you are able to hold out the lows that we had done on Monday of 16,800, that is where the 200 moving average also is there for the Nifty. If you're able to hold that and no intermittent bottom is created in the next few days, in the next 2 to 3 days, we can to a large extent be relieved that maybe the bottom is around us. Now to a question in terms of follow through days and some false breakouts which happened and again breaches which happened, we carried a very extensive report a year and a half back on previous cycles. So if you can go back to our resources library, I think you will find that report where we've analyzed how market moves have been, if I'm not mistaken, from the dot-com bust, including the global financial crisis, and therefore the and latter years as well, till 2018, on how the markets might probably behave. We are in the process of making a report as I speak right now. Me, Rajshekhar, Vakar, Rushid, the team is working on that with help from Rahi, Atisha, and Pavan as well on the charts. In terms of how the indices are placed at this point of time, how sub indices are also placed, looking at the larger indices at this point of time, which indices have shown a strong breakdown in terms of their RS structures. Within that, which stocks have shown wide distribution in terms of RS structures breaking down, earning strength breaking down as well, and which sectors are probably holding up, which can then give us a fair bit of an estimate that if markets are expected to bottom out, and if we do see a follow through day, even though Nifty might stay stuck in that broad range of 16,800, 17,800, or any of the conditions, as I said, factors and event related issues making knee-jerk reactions, price movements into the market, those averages getting breached, maybe even if FTD witnessed, but then more distribution days happening in a very quick amount of time and lower lows breached, then I think these sectors which might hold up as per the analogy and as per the methodology that we practice at O'Neill, and a lot of other data points that we are also considering, I think that will be a very, very interesting report as a follow-up on what you are trying to get through, maybe at this end of the week or the beginning of the coming week as well. Some key elements apart from the market structure is the Nascom report which came through, which projected a very robust scenario for the IT sector as a whole. The spending obviously is expected to increase $30 billion. So from $194 billion in 21, Nascom is expecting global IT revenues, specifically for Indian IT outsourcing players, to touch around $225 billion. The opportunity that comes through in terms of cloud, artificial intelligence, in terms of digital, I mean, a lot of sectors, companies are going digital, and therefore 30-31% of revenues being from the digital ecosystem for these players will ensure that better operating margins and EBITDA performance stays. Attrition remains to be a big issue as per the Nascom report, but there is huge opportunities in excess of $500 billion, which means that this space can continue doing well. A lot of stocks, as we mentioned in our earlier report also, which also includes IT, some large cap names, some mid cap names are in late stage basis. Some are having late stage 4, late stage 5 basis. So I think need to be a little bit more careful in terms of deciphering whether the gestation has actually happened in terms of positives being built in for the index, for the price. And therefore, I think we're trying to raise and interpret all these elements at play. A lot of these subsectors which might not get covered within the main or sub indices as well. As an example, I think specialty chemicals, textiles. What we are trying to do, not specifically for this report, but what we'll try to do post this report is that we'll try to analyze industry group rankings for textile and specialty chemicals individually, see the constituents of this sector and how different elements are getting played out, both in terms of RS ratings, in terms of EPS ratings, lot of other host of other parameters as well, and then try to stack up the peers, the index itself in terms of group ranking and the vast opportunities that are probably available at that point of time. So again, very volatile times. We need to be watchful. We have been over the last few days or weeks, but I think this volatility will sustain, will persist, and will continue for a confluence and a cocktail of events that are expected to play out starting tonight and ending on March 14, 15 till the actual rate hike happens. And therefore, I think being very selective, even if we see this next 3 days and the bottom not broken out and the follow through day witnessed, still having some sense of caution in approaching the markets and then going by our golden rule in terms of where ratings and earnings and price strength remains strong, robust, as we will obviously put forth in our report on what sectors can be looked out for, a large element of which I've already covered, can be a good guiding point as well. And we'll keep on seeing how the markets evolve as we move ahead as well. So that was my bit in terms of the placement of the market, our situation in terms of macros and micros at this point of time, global macros at this point of time, and how we are approaching that. We'll obviously address a few queries, which Rajshekhar Ivakar will now take up with you guys. So Vakar, we can start with a few queries. Or Rajshekhar, you can start with a few queries. Vakar can join.
Okay, thanks, Mayuresh, for the introduction about the indices and how the market is placed. We'll go ahead with the stock queries now. I'll take Dixon, another stock query. So this is how we read the chart, and we'll see how it is placed on the on the chart. As you can see, this is a daily chart of Dixon. We read the charts and how we make a decision upon our reading. You can see here Dixon is clearly below its 50, 100, 200 DMS, which is not a good sign for growth investors like us. However, its EPS is at 85, which is very good. It has reported very good numbers last 3-4 quarters. That is the reason of high EPS. However, RS has been lower at 18 because the stock has been falling or taking a profit booking. That is the reason RS is at 18. Initiating a good fresh position at this point is not advised in Dixon because the stock is trading below its key moving averages and it's technically beaten down stock. However, even though if you are holding the stock in your portfolio, you can consider exiting the stock, because you never know. There is no clear support for the stock at the current moment, because there are no moving averages below CMP. You can consider exiting the stock and stay in cash rather than losing in a stock. There are many stock queries. I think we'll take one by one as
Yeah.
the session
So
progress.
So go ahead. I think one point that I just wanted to take up with you guys is, as Rajshekhar mentioned, right? A lot of stocks, if you go through the report, are trading below the 200-day moving average as well. So I think that's not a very good sign, right?
Around
So any
50% of the stocks are around the 200 DMA or below the 200 DMA in the
Exactly.
entire universe. Entire
Exactly.
universe of listed stocks.
Exactly. So I think if volatility increases further, I think further breakdowns might be witnessed here.
Correct.
So the best way to play out is not look at stocks which are trading below the 200 DMAs. I think that's been a ground rule, right, for O'Neill.
Right.
And the basic rule has been that even if you hold certain stocks, you shouldn't be probably holding for the stock to break 200 DMA. You should be exiting your positions if volumes are extremely high and near-term averages like the 50 DMA, which is also very important and a crucial moving average, has been taken out with extremely heavy volumes, right? So for the sake of repeating, again, I think what we've seen in the past is that टेक्निकल जब होते हैं तो आई थिंक फंडामेंटल जस्टिफाई नहीं करने चाहिए सो lot of global institutions follow this practice of following technicals for selling only, and they only look at selling. They look at technicals only when they are selling. Indian context mein, specifically retail context mein, we try to justify fundamentals when such structural things are being seen in the market. And again, I think this year, or what we've seen in the last year and a half, is going to be a year of consolidation for the markets. Choosing the right sectors, and being in the right stocks in the right sector at the right point of time is going to be the right strategy. It's going to be challenging. It's going to be a lot of hard work in identifying that. Maybe we might be a little bit late, we might be a little bit early, but I think that is the only way forward as I see it, because this year is going to be a year of consolidation and normalized returns as well. Thanks.
Rashikar, can I take a few queries?
Yeah, sure. Sure, Vakar.
So can you give me the chart for Astral? Someone was like repeatedly asking for Astral and a couple of more queries.
Okay, sure.
Again, what Mayuresh was talking about, like most of the stocks, or greater than 50% of the stocks are below the 200 DMA. Astral, again, a good story. Numbers were decent for Q3 FY22. I mean, our team attended the con call as well. But looking at the technical strength of the stock, I mean, price strength of 20, buyer demand of E, and the stock not just like around the 200 DMA, but well below the 200 DMA, clearly shows that the stock is not having that technical strength at the moment. So any fresh buying position, according to William O'Neill, would not be suggested at this point in time, but would still like to give away some snippets from the Astral earnings call. So, I mean, the cost inflation was clearly evident with them as well, and they're not able to pass on their entire price hike. But the good point is that the guys are seeing good growth. I mean, even while the industry degrew by around 4.5% in the 9M, but Astral grew at a faster pace than the industry, and they're seeing good growth in the housing demand, and the inventory with the retail developers are also falling, which is likely to benefit across company segments. And they will be introducing new products in sanitary and faucetware, and they're hoping that these products will have normalized revenue by FY24, and the launches will happen in like FY23. So yes, the story with the company remains in place, but at this moment the stock is not showing any technical strength. So wait for the market to bounce back, wait for the volatility to pass through, wait for the stock to show strength, and then probably we can look at the stock. Is there on Mindtree as well? Mindtree. Again, a good stock that probably had like great outperformance in the last 1 year or so, if we can look at it. But with the market beating, the stock came down towards its 200 DMA and somewhere like took support around its 200 DMA bill. And the key thing you can look at from a technical perspective at this point is, I mean, the moving averages line at this moment, like the 21 DMA is downward sloping. They have like intersected in a downward manner. So that is not a good technical setup if you want to look at. On the left hand side, if you look at the quarterly earnings and the top line for the company, it's been growing at good numbers. But yes, the entire as Mayuresh explained earlier, I mean the IT sector has been facing the attrition issue, but according to the Nascom report and everything, the top line should be growing at good pace going forward. But again, new positions at the moment with with the stock is not advisable because still, even if the stock is trading above the 200 DMA, it's still far below the other key moving averages, and the relative strength is not there with the stock at the moment. Raj, can you take a couple of queries?
Yes, Waqar, I was about to take. I'll take two major bank queries, that is ICICI and HDFC Bank. ICICI Bank currently is trading in its handle portion of stage 3 Kpit handle, as you can see here. However, it is trading below its 50 DMA and near its 100 DMA. The handle portion has been very ideal for our methodology. The volume has been on lower side in the handle portion as well as in the base formation portion. There have been some few positive pointers related to banking sector as a whole. NPS have been coming down for major banks like ICICI, HDFC, SBI as well. However, recently a shipbuilding company has reported defrauded a huge amount of loans to the banks. These kind of news items are negative to the banks like ICICI, HDFC, because these are the banks which lend in huge amounts to many companies. That is the reason for a small correction in the stock as well. That is reflected in its price strength of 35 because it is underperforming the overall index. But being a very good company, fundamentally, its IPS is at 86. It has been reporting very good numbers on sales front as well as on EPS front. You can see the number of funds which are invested in the stock, 1.8K, and it is still growing at a good pace compared to growing companies. It is also in line with the growing companies. Taking a fresh position at this point is not advisable because of minor correction in the stock. We would want the stock to close above its pivot of 863 on a very good volume. Also, we will want the overall market to show a sign of a rebound and macro data like inflation and geopolitical tensions to be eased as well, because ICICI Bank is a major bank in India, and every factor will also have impact on ICICI Bank because they have exposure to many companies in India. Coming to HDFC Bank, it has been consolidating for the last 1 year. You can see here the stock has been trading in a narrow range of 1700 and 1400 range. There is no clear momentum on the upside as well as on the downside. Being a very good company, fundamentally its EPS is at 90, but because of underperformance or consolidation, its price strength is at 19 because of its underperformance compared to most of the stocks in the market. It is currently trading near its 200 DMA. 200 DMA is a very good support for the stock historically. We want the stock to close trade above that level, and if you are holding a stock in your portfolio, you can continue to hold with a very small stop loss of 1% from this level. But initiating fresh positions is not advised at this moment. I think there are many queries related to stocks.
Rajshekar, there are a few queries on the top as well. So did we cover Bandhan and Axis?
Correct. I'll continue with this stock, with this banking queries.
Yeah. So banks, guys, has reported a fabulous set of numbers, right? You take any bank,
Correct.
whether it's a large cap one, public sector one, small cap bank, asset quality pressures are receding, provisioning is high, NIMs have got maintained, loan growth is coming back on normal. How does the rate hike cycle, if RBI does instigate one or change its policy stance, affect them? Largely sentimentally, but with the rate hike cycle, I think the readjustment in terms of their asset liability uh, book, I think, gets readjusted as well. So I think the advances get readjusted and the deposit buckets also get readjusted, which means there is no difference in terms of NIM spreads. In fact, the NIMs and spreads show marginal increase in an upcycle as well. So I think any strong liability franchisees, as most of the private sector banks are, a few of the larger public sector banks are, should report better. The only concern remains is if there is, again, as I said, and the caveat remains, in terms of a global slowdown, imported inflation, does that relatively affect Indian corporates borrowing? More liquidity tightening happening here as well, or only the better rated corporates getting access to credit, because the fear probably starts coming back for lower rated corporates. And where the need of the hour is, again, MSMEs and SMEs, right, which require bulk of financing for carrying on the last mile outsourcing manufacturing work, however you want to put it. So it's a very interesting phenomena, but I think these facts and figures do stay with banks. We can continue with Bandhan and Axis. Right.
Okay. Thanks, Mayuresh. Mayuresh has given very good overview of banking sector as a whole. As you can see, I'll talk about technical points regarding Bandhan and Axis. Bandhan has reported good numbers. However, because of high NPS and previous quarters declining EPS, EPS is at 29. And its RS is also at 28 because of underperformance compared to the overall market. Stock is trading above its key moving averages. However, taking into factor EPS and RS strength, fresh position at this point is not advised in the stock. If you are holding the stock, you can keep a minor stop loss around 21 DMA. And if you are having good profit in the stock, you can keep a 50 DMA as a stop loss. I'll take Axis Bank as well. Axis Bank is slightly similar to ICICI Bank, which is its private bank peer, which has a very good EPS of 93. However, its RS is at 32 because of underperformance again. During the base formation, the stock volume has been on the lower side, which is a good sign. However, during the handle formation, the stock has been very highly volatile because of general market, not just related to the Axis Bank. And fresh positions, I think it's a slightly risky proposition at this point because of volatility in the market and overall economy as well. If you are holding the stock in your portfolio, you can keep 21 DMA as a stop loss, which is 3% from CFD.
Yeah, right. I can take a few queries now.
Sure.
Raj, can you give me the chart for GHCL? I saw queries for GHCL.
Okay.
So GHCL still one of the few stocks, I mean, holding like above like major of its key moving averages, just below the 21 DMA, resting around 50 DMA at the moment, we can say. And I mean, the price strength, if we look at comparing it to the other stocks that we have looked at the moment, is still decent at 57, but still not at par with William & Will's methodology. EPS remains good. I mean, when we track the recent results, I mean, the company reported a decent set of numbers. And in terms of the soda ash, soda ash segment, the company is seeing that the soda ash demand is recovering and was strong during the quarter. I mean, utilization was around 97%, and the company reported around 12% volume growth. And overall, the segment reported around 45% YOY and 34% QOQ growth, with stronger volumes and realization. So, I mean, with management was pretty positive about the segment as well, seeing some kind of slowdown on the textile segment, but but with the spin-off happening in GHCL, the company is likely to concentrate on the soda ash segment going forward. So, I mean, if the market remains supportive, if we get an FTD day and the stock breaks out, probably at that point of time, one can look to add it, but with again a strong risk management rule of 8% stop loss.
Having said that, Vakar, I think the supply issues with GSPL faced, right, in this market volatility, breaking out of its base and pivot becomes extremely important. One more element is that the strong segment on the demerger that they're doing, the spinning segment still remains with GHCL.
Correct.
So caustic soda realizations have moved around 31, 32 odd rupees per kilo. The channel checks that I was doing in the previous week, they have stayed at these levels as well, which means demand from end user, as Vakar was saying, remains solid, robust. Pricing remains robust. Volume increase can create operating leverage, and spinning remaining within with their unit out of the textile demerger. I think that augurs well for earnings growth remaining constant. But albeit, I think the whole issue is that you probably need the pivot levels to go through in
the markets to remain supportive.
Absolutely. Just in that breath, I think we can also take GNFC and GSFC since we are doing GHC.
Yeah. I mean, in this market itself, I mean, the stock is above the key moving averages. Did break out, was the stage 5? See, again, late stage basis. William O'Neill methodology, it's prone to falter. I mean, later stages basis such as your 4, 5 or higher are prone to falter. I mean, but at this moment, not advise, or not any moment would advise to enter into a late stage stock breaking out. But I mean, looking at the price strength and the ratings remain good. But strict caution or strict advice not to like go into any later stage basis. The other stock?
GSFC.
Yes.
अच्छा, with GNFC guys, what is happening is budget में जो announcements किया था ना, acetic acid and the import duty / so on so forth. GNFC being a major producer of a lot of these components where these import duty slashes have happened, though I think is still a dominant player. Does that relate to price corrections in key products that are consumed locally by a lot of end user industries? And do they find imported options far more viable? I think we'll come to know that, but this is just one point to ponder for GNFC as well. Sorry, Vakar, you can go ahead with GSFC.
GSFC.
Sorry, which stock you are talking about, Vakar?
Rachikar, GSFC, Gujarat State
GSFC.
Fertilizer.
Okay, fine.
Yeah, because somebody had asked that query.
Yep. I mean, the only thing, the good part about the stock is, the stock has been forming like the first stage base, and it's above the key moving averages, all key moving averages. But looking at the EPS trend, it's poor at the moment, and even the RS line is not trending upwards. It's like on a flattish zone. But we can look at the stock if the stock breaks out and the market is supportive. And similarly, what Mayuresh was talking about, the budget being supportive of the fertilizer players. Let's see how the stock pans out in the coming time frame.
Okay, Vakar, I'll take a few queries now. User called Study Material has been asking about Shivalik Metal and FCL. I'll take that. Shivalik Bimetal has a very good stock. Even though there is a mild correction in the market, stock is showing good signs of resilience. It has not breached its 50 DMA, which is very good sign. We have now looked into its business operations, but looking at its EPS strength, which is at 96, we take it as a very good, fundamentally strong company. Because of its outperformance in the current market, its EPS, its price strength is at 93. Everything about the company is looking good and technically and fundamentally. Number of funds have increased 66%, but the catch is here. There's just uh, five funds which are invested in the company. So obviously, whenever there is one or two fund investing, the percentage of change will be higher. This should be taken as a cautiously rather than just looking at the percentage change. But speaking about this technical and fundamental parameters of this company is very good. But what we feel is the stock is extended 83% from its 200 DMA. And if the market goes into a slight phase of correction or consolidation from this point, we can expect stock to have a good profit booking and breach its 50 DMS because of its highly extension from 200 DMA. Initiating fresh position is not so advisable at this point because of high extension. We would want the stock to consolidate and give a breakout rather than going in just one direction. And the same user has a query on FCL and Dwarikesh as well. I'll look into those charts. Dwarikesh also is a similar market cap company around 1.5 thousand crores to 2,000 crores company. It is in a very good momentum compared to the overall market. It is not. It has showed resilience. However, you can see the number of funds are just four in the company. That is, there is no institutional activity in the stock. I think it is most of a retail play rather than institutional play. It has reported very good set of numbers. Hence, its EPS is also at 71, which is fair enough for a company on only front. Its price strength is also at 74, which is okay-ish. But the only problem is that we would like the institutional funds to be at more than 10 or 15 because institutions have more knowledge about a particular company rather than retail investors. And also the stage breakout is a third stage, which is a slightly late stage, we can say. And currently stock has been at near its profit booking zone. If you are holding the stock in your portfolio, you can consider you can keep 21 DMA as its stop loss. And initiating fresh positions is not advised at this moment because of its high extension or late stage base breakout. I'll take Dwarikesh as well.
Yeah, and GMDC as well after Dwarikesh.
Okay, Mayuresh, I'll do that. I think the last two stocks, the similar stories with Dwarikesh as well. It has been very resilient in the market compared to huge profit bookings or selling pressure in most of the stocks. Dwarikesh has just breached its 21 DMA, but it is trading above its 50 and 200 DMS, which is a very good sign. On market cap front, the last two stocks are also having the same market cap around 1500 to 2000 market cap. The good thing about Dwarikesh Sugar is number of funds at 44, which is very good sign for a small market cap company. having 44 institutional funds invested is a very good sign. It shows a fundamental quality of the stock. Institutions are highly positive about the stock. That is why 44 institutions are invested, and it is also rising on quarter basis. Its EPS is also at 84, indicating good set of numbers for the last 2 to 3 quarters. And if you are holding the stock in your portfolio, you can keep it's a 50 DMA as a stop loss, which is 9% from the current market price. However, initiating a fresh position is not advised at this moment. I'll take a GMDC and my colleague Vakar will take the other few queries. As you can see here, GMDC has broken out from stage 3 consolidation base, which has a huge length of around 167 days. That is almost 3/4 of an year. However, after breakout, you can see the growth the stock has given. It has about 70% in just 25 days. This is the reason we add stocks on breakout. You can see here, it's a very good breakout. The volume has also been at around 14 times the average volume. This is a very good breakout on technical front as well. Looking into its fundamental strength, EPS of 73 is fair enough for a stock of market cap around 4,000 crores. Technically, it has clearly outperformed most of the stocks in the Indian market. Hence, its EPS, its RS rate is at 84. It is clearly trading above its moving averages. If you are holding the stock in your portfolio, you can continue to hold it. However, being a extended stock, even it's a small moving QV average like 21 DMA is at 17% from CMP. So I think we can keep that as a stop loss because there is no clear support at this particular point of time. However, initiating fresh position at this point is not advised because of highly extension from 50 DMA as well as 200 DMA. If there's any minor correction in the market, this stock will take a huge selling.
Rajshekhar, I can take a few questions.
Yeah, Vakar,
Mayuresh, you're saying something?
Just take, I think, Tube Investments, Elecon, CAMS, and Birla Soft in that proportion, the last few queries which have come through. And Manish had a few queries on Aavas and Power Grid. And I think with these 6 queries, I think we can just take it in or take SRF as well. Last 7 queries. जो अभी last में आया ना सब वो एक बार खत्म कर लेते हैं, है ना?
Okay, I'll take these. So if you talk about
so Govind bhai, Kiran, Thyrocare ka bhi I think we'll have a quick look through. Vakar will have a quick look through. But Govind bhai, Uflex, Praj, Deepak, thoda paucity of time hai. But you can write into these to our support mechanism and we will reply back to you. So I think ये जो 6-7 queries या 8-10 queries miss हुए हैं, you please write into us. So the team, Rajshekhar, Vakar, Rushit, myself, we will have a look at it and we will get back to you. So I think even if you are not able to answer that for paucity of time, please do write in and we will make it, I mean, assure you that we will answer back to you on all your queries. Thanks a ton.
Yeah, so I'll go ahead with Tube Investments. I mean, if you can look at it, I mean, the stock has breached some key moving averages and somewhere. Can you show me it's like around the 100 DMA right now? Yeah. Yep. It's breached its 50, but it's trading around its 100 DMA, and it's not, I guess, a late stage base, and the number of funds has been increasing. I mean, the shares held by funds are also increasing. It has a great EPS strength of around 96. But with, I mean, what we can probably see it as the market weakness is dragging the stock lower. And if someone wants to look at the fundamental side of it, the stock is into 3 to 4 major businesses, One's the engineering division that drives around 44% of the revenue. Second is around the metal form products that drives around 34% of the revenue. Cycle division 17%, and gears division around 5% of the revenue. So probably the market sustained strength, and the stock can reclaim its key moving averages or re-breakouts over that 1798 levels, and probably one can have a look at this stock. Before that, we would not advise you to have look at the stock at the current moment. Kpit, I guess Kpit was there. Kpit was, okay, SRF. SRF was one of the queries.
Hindustan HIL, and we can just take it a little bit more quickly. Though I don't like it, I think we should be spending time. I just wrote it on chat as well. Because then we will not learn, right? All of us are learning. We are also learning. You guys are also in the same phase where all of us are going up the learning curve. If we address queries in 30 seconds, it will not make sense. But since you guys are asking, we will follow. I mean, we'll pick it up and hasten the process. Now, aap kar lo, Vakar. Just take queries quickly in 30-40 seconds.
Yeah, so as like Mayuresh was talking about that specialty chemical space, SRF being one of the key beneficiaries like of that specialty chemical space, you can see that, I mean, the institutional holders showing keen interest in the stock. 57% QoQ rise in number of funds, 377% rise in the shares held by funds. But was a negative point we can only look at is like, again, not a completely late stage base, but can take it as a late stage base considering the market correction at the moment of stage 3. So yes, I mean, the stock was not able to sustain above its pivot, and you can see the stock is clearly trading below its key moving averages at the moment. Fundamentally, the story and the I mean, the earning strength for the stock remains really to remain conducive for the stock to rebound at the moment. Elecon, yeah. One was Elecon, then Kpit. Give me as many as possible, I think. Apart from the last couple of weeks where we're seeing that the RS rating line has been trending down, the stock has been a major outperformer if you look at the past 9 months, excluding the last couple of weeks. And I mean, the EPS strength is strong. I mean, even with the beating down, the price strength is still fair, but with still that fair price strength, you can see that the stock is below the 200 DMA. So again, market is coming to like even the good stocks as well and taking them below the 200 DMA at the moment. So, but the institutional investors are still very much inclined with the stocks. So let's wait for the stocks to reclaim its key moving averages and the market to be supportive of the same. Keep it. We can say like one of the tech stocks that have been like showing huge outperformance with respect to the market, even with the recent market correction, a price strength of like an RS line of 86 and still trading just below like its 50 DMA can be like a huge positive for the stock. But if you look at the other aspects in terms of initiating new position with the stock, I mean, it's around 53% of its pivot, and really not advised at the moment to have any new position with this stock. Birla Soft. Again, we can see that like the good outperforming mid-cap IT companies, but yes, we can see that the stage was one of the late stage bases 3B. You can see, and the stock wasn't able to sustain the breakout, and at the moment it's like around its 200 DMA. Took support at its 200 DMA, but like fresh positions are highly unadvised. As you can see, the moving averages lines have been trending downward, and the stock is well below its key moving averages at the moment. Raj, if you want, you can take a few.
Wakar, I'll take clean science and not to stock queries as well. There is one query from Subaru. It's a generic query. I feel how to find stage 1 to stage 3 and from the charts. Uh, uh, on the benefit of everyone, I think if you point the cursor on the base, you can see here a pop-up comes up which shows a stage count and pattern of the base. Clean sense, you can see it has formed a stage 2 consolidation base. Pivot is also mentioned in that pop-up. And how do we identify stage 1, 2, 3, and that is explained in our learning articles, as well as we have a few videos on our channel as well. I think you can go through them to have a clear picture of it. Coming to clean science, we had a call with clean science management in the last quarter. The company was very confident and the margins they were reporting were very good, about 60-70% on the gross level. However, recently the stock has been under pressure because of a huge selling which is seen in the stock. But the volumes on the selling front were below average, uh, which should be taken positively. We can see the number of funds invested in the stock are increasing at 60% on quarter-on-quarter basis. However, looking at EPS of just 5, which is lowest compared to other stocks, and RS of 38, taking fresh positions is not advised at this moment, even though the company is doing very good on the margins front and revenue front as well. If
Raj, can I add a couple of points on clean size as you have taken it?
Sure,
I mean, we had attended the call. So, like, as Raj was completely pointing out, what I heard from the call was that the company has been facing elevated freight and RM prices, but they feel that it remains a short-term challenge for the company. And if you look at the investor presentation of Clean Science, I mean, the key raw materials such as your phenol, your tertiary butanol, your methanol, all, if you look at not just YOY, but even the QOQ rise in your RM prices, it's been really high. I mean, for phenol, it's around 6%. For methanol and tertiary butanol, it's around 34%. Coal is around 20%. But yes, the company is on their expansion strategy of Unit 3 and Unit 4, and they are really highly positive that the new products, or I mean, even the existing products that have the leadership position, such as your MEHQ, your Goicol, will have good margins going forward. But I mean, the one common thing that we've been hearing from the management across the con calls is that cost pressure is there, cost pressure is evident. And even with the hikes, with everything, they are not able to pass on the entire cost inflation to the people. So, but they're confident of passing on some more in Q4. But that would be I mean, with the demand for that, the demand environment needs to be supportive. So let's see how the Q4 and the Q1 numbers get reported, and can we see some kind of bounce back in margin from these companies as well. So sorry, Raj, you can take it from here now.
Sure, Ukar. I think our session is scheduled for just 1 hour from 4:30 to 5:30. We are already past that timings. However, for the benefit of everyone who has been asking queries, I will take one or two queries from here. You can always write to us on our email, which is given in the chat box. We'll clearly explain our methodology and how to go about that particular stock. I'll take Pi Industries and DMart, and I think we can close the session. Yeah, Pi Industries. Again, you can see which is a very good, fundamentally strong company, agrochemical company, which is majorly into pesticide manufacturing. It is under selling pressure. It is more than 25% down from its highs. It clearly breached its key moving averages like 50, 100, 200 DMA. It has slightly trading above its 21 DMA, which is a short-term moving averages. However, being a underperforming stock, its RS is at 14. Fundamentally, there is no doubt about the stock. EPS is at 76, and institutions have put support for this stock. And However, looking at O'Neill lens, initiating fresh position is not advised at this point because the stock is trading below its key moving averages. If you are holding the stock in your portfolio, you can keep 21 DMA as a stop loss, and you can exit once it is breached. I'll take a DMART, and I'll let Mayuresh to say a few words about the session, and we can close the session. Okay, DMART, which has been very good on a very good trending movement since it is listed in the markets. You can see the stock has broken it from stage 4 base. There is only uphill for the stock but however recently there is some downhill because of profit booking or selling pressure, whatever you can see. Fundamentally, the stock has reported very good numbers. You can see the sales numbers as well as the EPS numbers have been more growth rate has been more than double-digit growth, which is ticking our boxes. EPS of 92, hence. However, because of profit booking and stock breaching its key moving averages 50 and 100 EMA, its RS is at 31. The good thing about this stock on technical front is it has not breached its 200 EMA. You can say 200 EMA as a very good support for the stock because it has tested that level more than a couple of times recently in the last 20-30 sessions, but it has not closed below that level, which is a good sign. If you are holding the stock in your portfolio, you can keep that level as a stop loss because of very good support. However, initiating fresh position is not advised in this stock. If the stock reclaims its 50 DMA, then we can look at it. I think we'll close the session because we are already 10 minutes past the scheduled time. Wakar or Mayuresh, if you have any closing comments, we can put in and we can close the session, I think. This Thyroid and Manappuram, I think we can write to you can write to us on email. We'll definitely reply to you guys clearly explaining the fundamental and technical fronts. I think we'll close the session at this point of time.